In the economy this week, manufacturing, jobs, and even the European Central Bank made some economic news. Let's take a look. Before we begin, remember to like this video and subscribe for more economic updates. On Monday, the Institute for Supply Management reported that its manufacturing PMI unexpectedly dropped in May, defying expectations of a slight increase over April. The index ticked down a half point to 48.7 from 49.2, putting the metric at a 3-month low. It's the second consecutive month and the 18th time in the last 19 months the index has landed in contraction territory. The new orders index, a component measure of the broader index, tumbled even deeper into contraction territory, falling nearly 4 points to 45.4 and close to a one-year low. Looking ahead, analysts say the economy's industrial sector is unlikely to pick up any real steam until interest rates start coming down. As for activity in the services sector, that appears to be a different story right now. Services PMI rose nearly 4.5 points last month to 53.8 from 49.4 in April. Also this week, the Commerce Department reported that construction spending fell 1/10 of a point in April to $2.1 trillion, disappointing analysts who were looking for spending to increase by 0.2 of a point on the month. The headline jobs metric was, of course, the government's non-farm payrolls report for May, which, if you take at face value, suggests the economy is still roaring, despite interest rates having been at 23-year highs for nearly a year. According to the Labor Department's numbers, the economy added 272,000 jobs in May, far more than the 165,000 added in April, and the 180,000 projected by economists. As a technical matter, the unemployment rate did tick up to 4%, the first time it's been there since January 2022. But economists say the real story is much larger than expected jobs gains and what that could mean for possible interest rate cuts. Today's data undermines the message that the other economic data have been giving of a cooling U.S. economy and slams the door shut on a July rate cut. On that note, the noise from the non-farm payrolls numbers did drown out 2 other job figures released this week, each of which pointed to a possible slowdown in the labor market. The April Job Openings and Labor Turnover Survey, also known as the JOLTS report, revealed that job openings fell for the second month in a row to 8.06 million from a downwardly revised 8.36 million openings in March. Also, the National Employment Report for May, issued on Wednesday by payroll processor ADP, said private sector employment rose by just 152,000 jobs last month. That's well below both the 172,500 jobs expected by economists and the downwardly revised gain of 188,000 jobs posted in April. Finally this week, the European Central Bank became the first major central bank to lower borrowing costs since the current cycle of inflation began sweeping across the globe 3 years ago. On Thursday, the ECB announced it was cutting rates in the Eurozone by 1/4 point from an all-time high of 4% down to 3.75%. As momentous as the initial decrease in rates is, the future path of ECB monetary policy remains unclear. Eurozone inflation actually ticked up in May, rising 2.6% year-over-year from 2.4% in April. And in a statement, the ECB insisted it would keep interest rates sufficiently restrictive for as long as necessary to ensure inflation gets back to the 2% target. That's it for now. Make sure to join us again on Monday when we dive right back into some economic news. This is Devlyn Steele for Augusta Precious Metals signing out.